I'm Charlotte McLeod with investingnews.com, and here today with me is John Hathaway. He is managing partner at Sprott and senior portfolio manager at Sprott Asset Management USA. Thank you so much for being here. Great to have you.
Thank you, Charlotte.
Really good to be catching up with you. And we're going to spend some time today getting into some of the points in one of your recent pieces. It's called A Cure for Financial Dementia. So I'll add the link in the video description as well in case people want to check it out. But lots of directions to go. I thought we could start with gold. So definitely a historic year for gold. It reached the 3,500 per ounce level. Of course, right now we're in a little bit of a pullback. But I wanted to begin by asking what factors you think are supporting gold right now.
Well, there are almost too many to mention, but I think first and foremost is the fiscal issues facing the United States, the oversupply of new Treasury issuance, and the questions around whether the market can absorb them at these prices without the Fed stepping in to manipulate interest rates as they tend to do. You have all of this badgering of the Fed by the Trump administration, where people are fretting about whether the Fed will remain independent, or is it going to come more and more under the control of the administration, which definitely would move in the direction of yield curve control, fiscal dominance, and so forth. So that's two. Three would be the ever-present concerns over the geopolitical situation, and there's not enough time to go into all of that, and I'm certainly not an expert on it, in any one of them, but you only have to look at the papers to see, what those are. And then the other thing that comes to mind is just the gradual movement away from the U.S. dollar as an international reserve asset, and conversely, the movement in the direction of certainly for central banks to own more physical gold to replace the dollar. So that's kind of a slowly progressing factor that it isn't a day-to-day thing, but it underpins the gold price. And I've probably forgotten a couple of, but those are the main things.
Well, I think it's very fair to say that there's almost too many factors to name, and definitely there's not enough time to go into every single one right now. But I find that people have gotten used to this high price level very quickly. And right now, what I'm seeing a lot of questions about from our audience is what will be the trigger to drive the gold price into its next leg higher? And in your piece, you mentioned that a major decline in equities is something that might not be being priced in right now. So I'm wondering if you could go into that and talk about what that would look like.
Well, if you remember what happened in 2007, when we had a meltdown in basically the entire financial system. I'm not calling for that. I'm not expecting it. And again, this isn't my expertise, but I do feel like we're in the top quartile, maybe the top decile in terms of exuberance, as Greenspan once called it, of overvaluation. So we're in a danger zone, and in my paper, I talked about a bunch of them. You have valuations, certainly. We're at the extreme levels of valuation. Valuation can stay high for a long time, so it's not necessarily it's not an aid to timing. You have heavy retail participation, which is, again, it's not necessarily by itself bad, but you look at the amount of day trading that's taking place in these zero day to expiration options, which are, I think in my piece, I mentioned 62% of options activity. You have extreme emotional support for a very few the market. I guess what I'm trying to say is the market is heavily concentrated, and the averages are supported by a very small number of names. And I can go back to when I was just starting in this business in the 1970s. We had something called the Nifty 50, and it's like a replay of today, or today is like a replay of the 70s, where all the institutions were heavily crowded into a few favorite names. They called them the Nifty 50 back in the 70s. And today it's, AI related and similar. So market concentration is another thing. So I don't want to go on too long about this, but I do think that when the tables turn, and I think we're, maybe within a year, maybe a year and a half. I'm not a timing expert by any stretch of the imagination, but it seems to me that if you look history, and there are other times when you've had, 2000 was a similar kind of thing. You had this mania in 2007 with mortgage-backed securities. So every mania is different, except the common is that you have market concentration and then leverage on top of that. I just saw today that margin debt topped 1 trillion for the first time. I mean, yeah, okay, market values are higher, so the gross is bigger, so the leverage could be bigger, but it's still a milestone. Anyway, not to go on about it, but in a downturn, as we had in 2007, as we had in 2000, as we had in the mid-70s, gold tends to get a bid, and it gets a bid from people that are incorrectly positioned in the market. And I would say that would be most investors. And we can also say that gold is underowned. And therefore flows out of the favorite names, favorite positions into gold, could substantially move the gold price. And again, when I look at sell side research, when I look at the what comes out of the strategy gurus on Wall Street, I don't think they have a clue as to what a reversal or what new inflows into gold, and more importantly, gold stocks, at least for us, could do to the price of both. Gold is relatively illiquid compared to the flows that could come into it and again, I'm not calling about a 10% pullback or anything like that. And again, I'm just maybe overly stressing that I'm not a market timing expert. But when the psychology turns less favorable and mainstream positioning comes more and more into question, one of the things that historically investors have gone to are defensive positions in gold shares. And in my view, that process, which needs to take more than 6 months, it needs to take 3 or 4 or 5 years, so that people get kind of worn out by not making money in their favorite names.
I think that's very true. And I want to go a little bit deeper on gold price and gold stocks. But before we go over there, I want to mention one other factor. I've been hearing when it comes to people talking about what could be the trigger for this next leg in the gold price. I'm starting to hear more talk about interest rate cuts from the Federal Reserve, especially after last week's speech from Jerome Powell. So I'm curious as to where you would put that in terms of your thinking.
Well, that is, I didn't mention it, but thank you for bringing it up. Yeah, lower interest rates, especially if it comes about with some sense that the Fed is being browbeaten and central bank independence is being threatened, just puts a bad look on the whole fiscal monetary discipline argument. And I don't know whether that's priced in or not, but it's a helpful tailwind for gold and mining stocks.
Thanks for going into that one. And so let's talk a little bit more about what's going on with the gold mining companies. You mentioned even though the gold price is so high right now, the miners are starting to put out these very strong results. There's still a lack of interest from the general public. So I know it's a tough question, but what do you think would bring investors back in? Why do you think they're not interested right now? And I know there's a lot of things we can go into there, but thoughts from you.
Yeah, no, I think, again, this is why, all the catalysts we talked about earlier, geopolitics, fiscal issues, all of that, de-dollarization, they're there. They're not going away. And that's probably why gold is trading effortless and appearing with the appearance of effortlessness in this range of 3,200 to 3,400. So, and any one of them could, without warning, come to the forefront and get more investors to look at gold and the miners. But the one thing that, and people articulate that. I mean, it's not as if it hasn't been talked about. But they're real. I mean, I'm not saying there's any way to dismiss them. But the one thing that's missing in this, again, and going back to the theme of my cure for financial dementia, is the market, the tables being turned in the market so that investors, broadly speaking, and I'm talking all the way from retail to institutional and official institutions, if their expectations for the returns they can get in the standard menu of holdings that they have, and we all know what they are, if that sours, and believe me, I think it will. I just couldn't tell you the exact date, but I think within 2 years is a reasonable bet. That is a catalyst for gold and for gold miners that it has not been priced in. And so, what's going to, it could be a lot of things, but we're at a valuation where we're basically priced for perfection with the S&P trading at a record level of enterprise value to sales, just to pick one. I mean, that's the Buffett indicator. Just look at history and respect history and say, maybe I should have some exposure here where I don't have any. And most people, would say, oh, we have a 1% position. Well, that's a CYA type of answer. That's like, I've basically answered that question, tick that box, but there's no conviction. It's just like I'm there if they're there at all, which most people aren't. So if that changes and we go from, let's pretend it's 1%, and that's probably more than it really is in terms of global AUMs. We figure 500 trillion. If it's 1% of that, I'd be surprised. If it goes to 2%, you're going to see things happen to the gold price and to the mining stocks along the lines of what I said earlier.
Well, and looking a little bit more closely at the gold mining stocks. So mentioned the last quarters have been very strong, and I'm curious about what you think we're going to see moving forward into the future. Are we going to continue to see this level of results? Because I know in the previous gold bull market, some of the big companies were criticized for ultimately making poor investments, some bad decisions there. And that might be now even why some people are a little bit wary of getting into the sector. So thoughts on their future performance?
Well, in my article, I quoted Galbraith, who said it takes 20 years for people to in this business to forget the mistakes of 20 years ago. And that's probably right. I mean, if you look at the cycles in the market, there's a new brand of idiocy every 20 years. And that's the inverse of that is that the stupid things that the mining companies did 20 years ago, and they did a lot of bad things. I think I referred to them as juvenile. Well, I think maybe they've learned their lesson, at least for a while. And what you're seeing now is more and more talk of increasing dividends. We're seeing a lot of share buybacks. We are seeing M&A, but so far, from what we can tell, our investment team that manages the active portfolios in gold mining shares at Sprott, we think most of these acquisitions have been sensible divestitures, streamlining portfolios, companies like Newmont, for example, doing that kind of thing. So, for now, it looks to me like what's taking place is sensible. And by the way, in a rising gold price environment, a lot of people look smart in retrospect because they bought XYZ asset thinking the gold price was going to be 2,500 and it's 3,500. Well, then everybody looks smart in that environment, but that's kind of where we are. So I think it's going to be a ways before we see the kind of derangement that we're seeing in large parts of the stock market.
Well, I think that's reassuring to hear. And then I think the other thing that investors are wondering right now is where to focus when it comes to the gold stocks. So the larger companies are delivering these strong returns, and people are maybe wondering, is it time to move down the food chain? And of course, each person is different depending on what they're trying to accomplish with their portfolio. But any thoughts you would share there?
Because there's so little research coverage of some of these mid-cap names, I've got to be careful with my compliance team not to mention a bunch of them. But I would say just anybody can look at our holdings, and you can see a lot of these mid-cap names where what I said earlier, where you're going to see potential earnings that exceed today's market caps. And that's what we are looking for. That's what we're favoring.
I did want to ask you about silver. So given your outlook for gold, what do you see coming for the silver price?
It's sort of hanging out below 40. We talked about it this morning on our daily call. And silver production, mining, is less than consumption. And so the market is in deficit. So you've got structural things that favor higher prices. If all of these other things that I think will take gold higher fall into place, silver will get a bid, and it tends to be more volatile than gold itself. It's a smaller market. Doesn't take as much money to move it. But I would say, order of magnitude, I think silver could do more in terms of percentage gains.
Well, I think that's definitely significant. And I feel like I almost don't need to ask this question, but I will. I was going to ask about the silver equities and the opportunity there, which sounds like it would also be quite significant. But maybe any advice on how to approach the silver stocks, given that the universe is quite a bit smaller than it is for gold, for example?
It's much smaller, and many of our holdings have been taken over. So the population of silver stocks that an investor could look at, and I don't have a number off the top of my head in terms of the aggregate market cap of the silver names, but it's quite small. Again, I think that the dynamics, and Maria Smirnova, who's a key member of our portfolio management team, is the real expert on silver, and she's written a lot, and it's on our website. But those stocks, I think, again, silver is a little bit more aggressive, but it tends to be in the slipstream of gold as far as dynamics, because it is a monetary metal. And the population of silver stocks has shrunken because of all these takeovers, many of which we participated in.
I think very, very fair assessment there. And so I will let you go unless you had any final thoughts that you would leave investors with. I know it's kind of a complex, tricky environment right now.
Well, I would just say, this is to the generalist. I think be open-minded, pay attention to the space, avoid complacency in your existing positioning and question it. And gold stocks and gold and silver are an answer. They're not the only answer. Maybe higher levels of cash would be appropriate. Maybe fixed income. There are, maybe the long-term, long-dated treasuries but this is not. I guess the quick answer to your question would be to question current positioning, and I think that is not being done. But I think those who do and land some of their exposure into this space will be very happy 2 or 3 years from now.
Well, I think that's a very nice way to wrap it up. So thank you so much for coming on to go over what's happening in gold and silver. This was really great.
Well, thank you for inviting me.
Of course, and we'll hope to have you back soon. For now, I'm Charlotte McLeod with investingnews.com, and this is John Hathaway.
Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.